Has everybody taken a 1031 class before? Is this something that you know about? We're going to do a little bit of an overview for 1031, and then we're going to talk more in depth today about title and ownership. So hopefully you have a little bit of an understanding, but we'll give you a nice overview in the beginning anyway. We typically run these sessions every month, and we try to hit a different topic every month. Even though 1031 is just one tax code, there's a lot of different components and a lot of different nuances to it. So we like to discuss things that we see on a regular basis. Next month, I think we're going to be talking about reverses and improvement exchanges, which has been a hot topic and in 2024. So I'm going to get started. Now that it's 12 o'clock, I'm going to just get started. My name is Michelle Fitzpatrick. I'm with Northern 1031 Exchange. I'm going to give you just a quick little disclosure in that we are recording this today. So if you are going to either turn your mic on or turn your camera on, ask any questions, just know that we are being recorded. If you don't feel comfortable with that, you can certainly disconnect now and we can send you this recording afterwards, but this will be recorded and sent out. So I just wanted to give you that disclosure. The presentation typically lasts anywhere from, 30 minutes to 45 minutes, and then I'll save some time at the end for questions and answers. Typically, this is a nice little discussion, so if you have any questions as I go, feel free to either raise your hand, put it in the chat or in the question and answer, but the easiest way to do it is obviously just unmute yourself and ask the question. That is totally fine. So let's get started. I hope everybody can see my screen. I'm going to just kind of go through my slide deck, and we are coming to you today from our new studio in our new office. So it's very exciting. We're using all new technology, and we're excited to have this new space. So 1031 exchange, like I said, it's an IRS code, and all it says is if you are selling real property that's held for investment purposes or business use, and you exchange it for property, again, that's held for investment purposes or business use, you can defer your capital gains taxes. So that's essentially what the code says, and this is here what it says on your screen. A lot of times people will tell us, you know what, capital gains tax is only 15%. It's much lower than my ordinary income tax. I would much prefer to pay the capital gains taxes and just move on, sell my property, pay the gains, and start fresh. And what a lot of people don't understand is that there's a lot of taxes that are involved with 1031 exchange, and it's not just the 15% federal rate. So if you look at the screen, you'll see that the federal capital gains tax rate is 15 to 20%. And a lot of times our Massachusetts folks, because their gain is so high, because the real estate market's so hot, the federal capital gains tax, a lot of our clients are falling into that 20% range anyway. So the federal capital gains tax is typically 20%. In Massachusetts, and I'm just speaking of Massachusetts, other states are higher, other states are lower, but there is, actually, let me jump. There's another federal capital gain. It's called NIIT tax, or net investment income tax. It's a Medicare surcharge that's been around for a few years now, and that's 3.8%. So if you're looking at just the federal part, we're looking at 20% plus the 3.8%. When you move over to the state side, Massachusetts has a state tax of 5% for any sale. And then this nice little millionaires tax came into existence last year. So we're coming up on almost 2 years. January, I think, will be almost 2 years that we've had this millionaires tax. And although most people say, well, I'm not a millionaire, it doesn't affect me. Unfortunately, it does affect a lot of people. So every dollar over $1 million that is earned is taxed at 4%. So we have a lot of people that are falling into that 4% range for Massachusetts. So as you can see, we're starting to add up. And then we have the federal recapture of depreciation. So any depreciation that you've taken in the course of the time that you've owned the property. You can depreciate residential property for 27 and a half years. You can depreciate commercial property for 39 years. Any depreciation that you've taken, the IRS is going to recapture at 25%. So as you can see, it starts to add up pretty quickly on how much the taxes would be if you chose not to do an exchange. It's certainly more than the 15%. So with any exchange, you will need a qualified intermediary, unless of course it's a swap where I buy a property, you buy a property, I want, we swap. You don't need a qualified intermediary. But for most exchanges where you're selling to one party and then buying from another party, you do need a qualified intermediary. That's the service that we provide. We act as that swap person. We act as that middleman. We hold the funds. We receive the contracts, and we act on the behalf of the exchanger. So if we're looking at this diagram, it's fairly easy. We've got the exchanger, the taxpayer, the seller, whatever you want to call that person, the investor. That investor goes out and they find a buyer to sell their property to. They get into contract as they normally would. They receive a deposit like they normally would. They use their attorney. They use their realtor. All those same steps happen. At the closing, what they're going to do is they're going to deed the property directly to the buyer, which is really nice. Qualified intermediary doesn't have to get involved in that. But the closing attorney or the settlement agent is going to direct the funds from the closing directly to the qualified intermediary. This taxpayer cannot have constructive receipt of the funds. So deed goes directly to the buyer, proceeds come directly to the qualified intermediary. We'll hold those on the behalf of the exchanger. And the exchanger now is going to find a replacement property, something that they can use for investment purposes or business use. They're going to go out, they're going to get into contract just as they normally would, and they're going to deed that property directly from that seller back to the taxpayer at the closing, and we're going to use the proceeds that we're holding to purchase that property. So that's kind of how it works. Now, there are very specific timeframes for 1031 exchange. You have 180 days total. So from the time that they close on their property, on their relinquished property, they have 180 days to take title to the new property, which is usually the easy part. The 180 days is usually not a problem. Really, where the problem comes in is the 45-day identification. They only have 45 days to identify suitable replacement properties that they want to purchase. So that really tends to be kind of the hardest part of the whole exchange process. 45 days are calendar days. They are, if your 45th day falls on a holiday or on a Sunday, that doesn't matter. You still need to identify. And the same with the 180 days. They're calendar days. If your 180th day falls on a holiday or falls on a Sunday, you need to close prior to that 180th day. The only time that those deadlines are extended are for federally declared disasters. And the IRS issues an extension. So right now they've offered very generous extensions for those who have been affected by Helene and Milton down in that southeast area of the United States. So they've offered extensions, I think, almost until May 1st. I got to go back and look, but for many of the counties in North Carolina, Florida, South Carolina, some in Georgia. So those are out there, and they've extended both 45 days and 180 days. So if anybody is in that area or has a business in that area, we can talk about that a little bit more and talk about the extensions a little bit more. So, as we talk about 1031 exchange, it's really important to understand that there are requirements. And one of the biggest requirements is that there needs to be a continuity of title and there needs to be a continuity of taxpayer. So sometimes that's not always the same. However, we look to the taxpayer who's declaring the income on the taxes every year? Who's declaring the losses on the property every year? Is it an LLC? Is it a pass-through entity? And we're going to talk a little bit about that. And hopefully that same person that is the taxpayer is actually the title holder. So we look to the registry of deeds and see who the title holder is on that property. So it's really important to note as we're going through our discussions with the investor, our discussions with the taxpayer, investor, exchanger, whatever that, whatever you want to call it, we are discussing who the taxpayer is and who the title holder is. Because when you purchase property, it has to be in the same name as the property that you sold. Really important. So there are a few exceptions, and these are called disregarded entities. So a disregarded entity is one that's ignored for federal tax purposes. So it's treated as a single member, and the tax reporting is done through the personal tax returns. So that most often is a revocable living trust. A lot of times people are putting their properties into a trust. The trust is not its own entity. It's not filing a separate tax return. Oftentimes they're doing it specifically for estate purposes. They're making sure that their property is going to be inherited properly or passed down properly to their heirs. So that's what the revocable living trust will do. Once we get into irrevocable trusts, the irrevocable trust tends to have its own tax ID number. We're getting into more of a regarded entity or a separate taxpayer. So this is a revocable trust is specifically is that exception, is what we're talking about for disregarded entities. Another disregarded entity is a single member LLC. So again, a lot of people hold properties as LLCs. It is a great way to hold a property to limit your liability in the property. It gives you that level of protection that people want, especially against maybe tenant lawsuits, or it kind of keeps that liability to a minimum on their personal side. So this is very popular. However, when it's a single member is the LLC from tax purposes passes through to the personal tax returns. So single member limited liability company or a single member LLC is also a disregarded entity. And a DST. So we're not going to get too deep into DSTs today, but this is something that we are going to talk about in the future. A Delaware statutory trust is it's an investment into a larger property. So you can become a fractional interest shareholder in a larger property, like a $100 million Amazon distribution center. You put your $100,000 share in, you're getting a dividend on this. It's held with all the other investors. But that is typically a disregarded entity as well. So we're not going to get too deep into that. We are going to have a whole other segment on DSTs. We're going to bring in an expert that handles DSTs on a regular basis, and we'll be able to speak to that intelligently, more so than I can. But we are going to just continue on with our continuity of title. So LLCs, we got into this. I was just at a conference in Nashville last week on 1031 exchanges, and we were talking a lot about LLCs versus S corps. Back in before, in the 90s, 80s, 90s, people were holding properties in S corporations. And to give them that level of protection. LLCs didn't really come around until the late 90s, early 2000s, where people really started to hold properties in LLCs for that liability protection. LLCs are much more favorable. S corps tend to have some issues there, so they don't get a stepped up in basis. There's a lot of things there, but with an LLC, it again flows through the personal tax returns of the single member, and it gives them the liability protection that they need, and it makes it for a really easy exchange. If you hold a property in a single member disregarded entity, like an LLC, you have the choice of either, when you're exchanging, you can either take title to your new property in the same LLC. You can take title to the property in the name of the individual as the taxpayer, or you can take title to the new property in a new single member disregarded entity, an LLC. So it gives you a lot of flexibility there, which is fantastic. Now, what I should say is that if it is a multi-member LLC, that is a completely different animal. So if I hold a property in an LLC and my neighbor is a member of the LLC with me, it's no longer a disregarded entity. So if we go to sell that property in the name of the LLC needs to take title to that new property with the same members in there. So it's really important to understand the difference between a single member LLC and a multi-member LLC. Remember, the multi-member LLC is its own entity and it files its own separate tax returns, and then it issues K-1s to the members. Tenants in common. This is a great way to hold a property, and I'm talking strictly from an exchange standpoint. So if you are, just because it gives you a whole lot of flexibility. Now, it's not giving you the liability protection that you want, and it's not giving you a lot of flexibility in trying to find financing, but I'm talking strictly from an exchange standpoint. If you are a tenant in common or a fractional interest shareholder in the entire asset, upon death, the owner's interests pass to the owner's estate. So if I own a property with my neighbor and I pass away, it doesn't go to the neighbor. It will go to my estate, and my children will become that 50% owner. And each owner may pass their interests their own way. So if you go to exchange as a tenant in common, and I own a property as a tenant in common or a TIC with my partner, my neighbor, whoever I bought that property with, if we sell the entire asset and I can take my 50% and go one way, I can exchange, I can buy another property, I can cash out, I can go into another investment with another person. It doesn't matter. I can do whatever I want. And my partner can do the same thing. There's a lot of flexibility there with tenant in common. We always suggest that there's a tenant in common agreement when exchanging with multiple partners. And that the exchanger's interests have to be clearly stated. So tenant in common, again, and here's the downfall though. The downfall is that when you purchase a large property and there's multiple tenants in common, let's say there's 5 people that have TIC interests in that property, financing starts to become a little bit of an issue. So it's a little bit harder for 5 people to go and purchase a replacement property and get financing as tenants in common. It's much easier for the bank or the lender to look at an LLC and look at it as a whole. So financing may be a little bit harder when we're looking at tenants in common versus an LLC. And again, liability is a little bit different. Now the liability is on the individuals, not the limited liability company. So again, tenants in common have pros and cons. From an exchange standpoint, tenants in common give you a lot of flexibility. From a bank standpoint and a liability standpoint, tenants in common are not as good. So you have to kind of make your decision and figure out what your exit strategy is going to be out of that property. So I'm going to talk a little bit about the same taxpayer rule with spouses. So married couples can face challenges to the same taxpayer rule in non-communal state properties, where each spouse is considered a separate taxpayer. So you have to understand where your property is, and if it's in a communal or non-communal state. That's a really important component. A lot of times we're doing exchanges. We may have to structure 2 exchanges for a couple or 1 exchange for the couple. So it really depends on how your state is classified as communal or non-communal state. And we come across this a lot in Massachusetts, where one spouse is on the title to the relinquished property and then they want to purchase a replacement property. So they're going to do an exchange. They sell a relinquished property, they purchase a replacement property, and now all of a sudden they want to bring in their spouse. And sometimes it works and sometimes it doesn't. It depends on how much the value of the replacement property is. So if both spouses are on the title of the relinquished property, then both spouses must be on the title of the replacement property. So we're going to get into just a couple examples right now to kind of go through it and talk a little bit about it. So with a married couple, a husband bought investment property prior to the marriage. He's the only person on the title. The property selling for $1 million and he's exchanging a property for $1 million. Can the spouse be added? So in this case, the spouse has to, the husband has to satisfy his own individual exchange by purchasing $1 million worth of replacement property. That is what's going to satisfy his exchange. If he adds his wife for a 50% interest share as a tenant in common, now his wife is going to be a $500,000 owner, and he's going to be a $500,000 owner. So in that scenario, he's buying down in value. He hasn't satisfied his exchange. He's going to have a $500,000 taxable gain if he includes his wife into that onto that property. So probably not a great solution for him. We would always recommend that he do the exchange in his name, and then if he wants to title a part of that property to his wife a couple of years down the road, he can do that. Massachusetts, I think you can gift properties with an unlimited amount. Don't quote me to that because I'm not an attorney or tax advisor. However, I think in Massachusetts you can give your spouse property back and forth without having any sort of issue. So we would recommend that your exchange goes old and cold. You take title to the property in just your individual name and then gift it later. Now, in scenario 2, if we're looking at this scenario with the same married couple, husband bought an investment property prior to marriage. He's selling his relinquished property for $1 million, and he's exchanging into a $2 million property. So now he's buying up in value, and he's buying up in value by 100%. So he can now take his wife on, and they can be tenants in common, where he owns $1 million worth of property. She owns $1 million worth of property in that one asset, that $2 million asset, and have a nice, easy exchange where he's satisfied his exchange and he won't have to do anything different afterwards. So, any questions about that? Good. I know I'm moving a little bit quickly, but I want to just make sure that we kind of get through all of these scenarios. So now we're going to talk about the difference between a multi-member LLC, which again is its own entity. So now the LLC is an entity, versus a tenant in common, and how that's going to look when you decide to exchange. So if we look at this first scenario, we have NBTC LLC. In this, LLC owns 123 Main Street. There are 3 members in this LLC. We've got Peter Pine, Paul Parker, and Mary Master. Each of them have a 33% membership in that LLC. Peter wants to exchange and go buy a property in Florida. Paul wants to exchange and buy a property in New Hampshire. And then we have Mary, who wants to just take her cash and go out and buy a nice luxurious asset like a boat. Can they do this? So in this scenario, it's a really, really hard thing to do to break up the LLC. In this scenario, as it is, if they were to just call a qualified intermediary and say, we want to all take our assets at the closing and go, we would say, no, you can't do that. The LLC, NBTC LLC, has to purchase the replacement property, and they all have to exchange. There's no way of breaking that up. So I shouldn't say that there's no way. We have certain techniques that we use called partnership divisions, partnership redemptions. They're very complex exchanges, and we typically utilize a tax attorney to help us structure those kind of deals. And what's really important is that everybody needs to be able to cooperate when doing a very specific partnership division or partnership redemption exchange. So cooperation is needed because the sale will be done in installments. Again, I'm not getting too detailed into it, but for this purpose, we're going to say that you're not going to want to break up the LLC. The LLC has to purchase replacement property. Now, we're going to take kind of the same scenario. We're going to look at it as a tenant in common, where we have same parties, Peter, Paul, and Mary. They each own 33%, but they are tenants in common. There's no LLC that's involved. And Peter, again, same thing. He's going to Florida, Paul's going to New Hampshire, and Mary's buying her boat. Can they do this? Yes. This is a very simple exchange. This is very easy to do. We're going to have 3 separate exchanges because they all have a 33.33% interest share in the property. So this we can do. Any questions about that? There are things called swap and drops or drop and swaps. The IRS says that you're not supposed to be doing any of those prior to exchanging. So a swap and drop is if you do the swap, you do the exchange in the name of the LLC. Let's say we do an exchange in the name of the LLC, and then later on you change the name. 2 months later, you change the name to tenants in common. They don't want you to do that. So there's no name changing immediately after you exchange. Same thing called a drop and swap, where right before you close, you drop the name of the LLC and you change it to tenants in common, and then you go to exchange. IRS doesn't like that either. So if you have the foresight to do this long before you're going to sell or long before you're going to list the property, that's certainly something that you can do. So if you know that in 2 years, 5 years, 1 year, whatever the number may be, that you're going to think about doing an exit strategy from your LLC, you can certainly break that LLC up, put it tenants in common, and then later on list the property and sell it and exchange it. That would be okay. So, oh, that was really quick. I thought I had a few more slides, so I am landing right around 12:30. So I'm glad that I gave myself a half hour for this session. Does anybody have questions about about the continuity of title, continuity of taxpayer? Give you some ideas about LLCs, holding it as an individual, holding it as a LLC or a trust. Can I answer any questions about that? You have to unmute if you want to talk. I don't see any in the chat. I see no questions in the chat. And I don't see any questions in the Q&A. So if there are any, you can certainly unmute yourself and ask, or you can pop it into the Q&A or into the chat.
I have a quick question.
Sure, Chip.
It's on the 45 days. I've read different requirements, but within that 45 days, are you limited in the amount of properties that you can designate as replacement properties? I've heard that there's a maximum of 3. I'm not really sure what the answer is.
Sure. Yeah. So I am going to stop sharing my screen and I'm going to try to find a slide real quick for you. But we do have, there are 3 rules of identification. And the first rule is the rule of 3. So that allows you to to identify 3 properties. And that's kind of the most popular rule. It allows 3 properties and it doesn't matter what the value of the properties are.
Okay.
So,
3, okay.
Yep.
Good.
However, if people are diversifying where they're buying they want to buy 5 properties. They're selling an apartment complex and then they want to go buy 5 properties.
Right.
Well, the rule of 3 is not going to work then. So they have what's called the 200% rule. And the 200% rule says that you can identify an unlimited number of properties. However, it cannot exceed 200% of the value of the property that you sold. So if you're selling $1 million property, you can identify 10 $200,000 properties. You can identify $2 million worth of property.
Okay.
So I'm going to just put it up on my screen so you, oh, that's not the screen. I'm sorry.
Okay. Well, that's understood. I appreciate it.
Yeah. And then there's a 95% rule, which isn't used all too often, but the 95% rule says that you can identify an unlimited number of properties for an unlimited value, as long as you purchase 95% of everything that you identify. So a little bit more flexible, but you have to be sure of what you're purchasing. So I put that up on my screen if you can see it.
Yes, thank you.
Yeah. Any other questions? I didn't get into the real basics of 1031 exchange. I gave you kind of a quick overview in that we've done the basics quite a few times, and we will, of course, do it again. We just didn't do it today. We wanted to really talk about the title and taxpayer specifically.
Michelle, I have a quick question.
Sure.
What if you're exchanging the property and the value is significantly lower than the one you're selling?
You're going to pay taxes on the difference.
Okay, on
Yeah.
the entire amount. So if
Yeah.
the difference is like 50%, you're paying taxes on the 50%.
Yeah, but you really do want to work with your qualified intermediary just to make sure that it makes sense, because you have to buy something that's the only way an exchange works is that it's over your tax basis. So that whatever you're purchasing, if it's going to be down in value, you have to make sure that it still makes sense to do an exchange.
Okay, got it. Thank you.
You're welcome. Any other questions? Anybody seeing anything out there that's maybe a little bit weird, or any concerns that they have about exchanging? You know, we have a lot of people that are concerned about finding replacement properties. And one of the things that we always tell them is that, yes, the 45 days is very restrictive. However, the clock doesn't start ticking until they actually close on their property. So, you know, they have typically, when somebody takes a contract for a purchase for a property that they're selling, they typically have about 3 to 4 weeks before they actually close on that. So they'll take a contract and then they wait until the closing. Well, they have all that time to shop, plus the time from the time that they close, they have another 45 days. So what we're seeing most often is that people who are exchanging, and by the time they close on the property that they're selling, on the relinquished property, they already have a property lined up and ready to go. So we're holding in this exchange period is typically happening in about a 22 to 25 day period for us right now, because most everybody has a replacement property lined up by the time they sell. So we always say a really good real estate agent, you definitely want that bulldog to go in there and get you a property that you want to purchase and get your contracts accepted. I know, Anastasia, I know you popped that in the chat. Any other questions? You can either pop in the chat, or you can raise your hand, or you can unmute. So like I said, this webinar is going to be distributed out, so you'll get this after we end. And if you have any questions, my contact information is going to be right here, I think. So you can certainly contact me if you have any questions. And I appreciate everybody's time today, and I hope you have a wonderful day. Thanks for joining.
Thank you. Have a great day.
You too. Thank you.